time value of money comes key. So the three major areas, just allow me to write them as we start straight away. Time value of money. Time value of money is a critical area. And you are doing time value of money analysis. And remember, what are you analyzing for different cash flows? For different cash flows. So when you talk about different cash flows, you know that cash flows in your FM knowledge, we have regular cash flows and then we have irregular cash flows. So when you're looking at the time value of money, and time value of money comes in two aspects. You're talking about present value and you also talk about future value. And in BDA, in most cases, they look at you are doing discounting techniques. Those are the major areas of focus, especially in BDA. They look at discounting. We know that future value is compounding. When you're looking at the present value, it is discounting. So we are going to look at time value of money. And the second bit that you need to look at is loan amortization. Amortization. Examiners of late have really loved loan amortization. They've brought it quite a number of times because it applies closely to the real life application of financial management. And in this meeting, I believe that there are those members who are working in banks or financial institutions. There are those members who work in SACCOs. There are members who work in microfinance. Remember, loan amortization, given the financial institutions, their major source of income is the interest they make from the loans they disperse to members. Loan amortization become key. Even if you don't work in those areas, at one time or the other, you will or you already have a history of taking a loan. If you have this knowledge, you can always compute for yourself. You just ask them, what is the interest rate that you are giving me? What is the period that you are giving me? How much loan are you giving me? And you can compute for yourself and know how much interest are you going to pay total at the end of the period when you service your loan in full. You will know because of this knowledge, so that someone cannot come up with some hidden fees and hidden costs. I hope I'm not stepping on the toes of those who are working in these institutions. I have nothing against you. I'm just, letting all of us know that some of these institutions, some of them might be bringing in, some, hidden costs that you might not be aware of. But if you have this knowledge, you can easily run your amortization schedule for yourself and know that when I service this loan in full, this is what I'll pay. And this is the monthly installments I'm paying. Interest bit of it is this, principal bit of it is this. This knowledge is important. That's why I believe that examiners of late have loved loan amortization, because they know it relates closely with what we interact with in our daily basis. The third area and the last area in FM is project evaluation. Project evaluation. And when we talk about project evaluation, there are various methods of project evaluation, which I believe you also know. So these are the major areas that I would want us to look at. And we are going to select questions that will test on those various concepts, so that at the end of the day, you are well versed with this. So FM is not wide. It is not wide. The only thing you need to know are the various specific concepts that you need to make sure you know. Now, I will do random things that you need to make sure you know, especially when we talk about time value of money. You know very well we have irregular cash flows and we have regular cash flows. So when we talk about irregular and regular, and basically I want to lean on the discounting techniques. And when we talk about discounting techniques that you will be required to apply in this area, you realize that in discounting techniques, we are dealing with regular and irregular. So what is discounting? Is the process of determining the present value of future cash flows. So that's what discounting means. Determining present values of future cash flows. That is simply what we mean there. Determining present values of future cash flows. And in this section, we want to look at two of them. Irregular. Let me start. It's okay. Irregular cash flows and regular cash flows. you need to know that when you'll be using these approaches, you have two types of cash flows. And when we talk about irregular and regular, we already know irregular simply means non-uniform. Regular means uniform. Yes. So irregular, non-uniform, non-uniform. And then regular means uniform. So the cash flows are uniform. And this is where we talk about annuities. All right, I don't want to go much deeper than that. Once I just mentioned that, you already should be able to relate and remind yourself of what those means. And when or which approach, which discounting techniques do we use to discount irregular cash flows? Irregular cash flows. When we talk about irregular cash flows, what discounting techniques do we use? We know that irregular cash flows, we use present value interest factor because the cash flows are irregular. And when we talk about regular cash flows, we use present value interest factor of an annuity because now they are annuities. The amounts are regular. They are constant amounts over a certain period. We use PVFA. From your, manual examinations that you've been doing along, I believe you know the formulas that apply. Because even in BDA, you will either use Excel function or you can still apply the knowledge of FM that you had covered before. It will still apply. And just a quick mention, PVIF is 1 plus R raised to negative N. I believe that is something that all of us can relate. This is just a reminder. It is just a reminder. We know that it is 1 plus R. 1 plus R, 1 plus R, and that normally comes in a bracket. So 1 plus R raised to negative N. And I believe all of us can relate to that formula. When we talk about PVFA, present value interest factor of an annuity, where we have now regular cash flows. Regular means uniform, I've written here, and now that's why they are called annuities. So in this formula, how do you, it is the same formula, but now you transform it just a little bit. So for PVFA, we normally have it is 1 minus this smaller formula divided by R. So it is 1 minus which smaller formula? The PVF one. So I just open a bracket, bracket 1 plus R raised to negative N, raised to negative N. Then you divide all of that by R. You divide by R. R is the discounting rate. So this is just a quick reminder, and I'll not go further than that when we touch on the discounting. The only thing I would want to remind you, which I believe you already know, is when we talk about BDA and we are discounting, our major interest and something you need to remember is how to get NPV. How do you get NPV? We are reminding ourselves NPV, we normally know it's the present value of cash outflows, present value of cash inflows, sorry. Then present value of cash inflows. Let me just remove which one? Present value, or let me remove the present value of cash inflows. Then we compare or we get the difference with present value of cash outflows like that. And the cash outflows we normally know is the initial investment. Initial investment like that. So members, I believe you can remember, because let me tell you, once you have the concept, every other thing will fall into place. So that is a reminder. I was just putting it there so that you know. Now, when we talk about the discounting rate, when we talk about the discounting rate, and these members, I want you to be very careful. Discounting rate. In that formula of NPV that I've written above there, you see this formula of NPV I've written. We know what present value now means. We know what present value means. It is the present value of a future cash flow. And you know very well this is the present value of cash inflows. We know what inflows are. When you're doing project evaluation, you are looking at the potential of what you are receiving against what you are investing, so that you see, is the project viable or not? Is it a good project, or I will lose at the end of the day? Now, the discounting rate that we use in these formulas here, formula for PVIF and PVFA, the discounting rate, you remember, it is a very critical element in these formulas, and N simply means the period, so that is okay. Period of investment or the period of the project, that is direct, and you don't have to worry about that. The thing you need to worry about is the rate. These rates, you get examiners who might want to hide that rate, the discounting rate, and they may want you to compute it. I will get a very nice question that will be testing on that. Now, if you are not given the rate And examiners who normally hide that rate will be testing you on something called the Fisher's equation. I believe, members, I believe you still remember the Fisher's equation, because it will help you to get the discounting rate, where the examiners will bring aspects of the real return, effect on that rate, or maybe inflation, effect of inflation on the rate. Then they also want to test you. Can you remember there was something called the money rate or the nominal rate? So you need to please make sure you remind yourself and don't forget. Whenever they hide the discount rate and they want you to compute it, putting into effect, the effect of inflation and also the real rate. I believe you've bumped onto questions that have those rates and they want you to have to compute a nominal rate or something like that. Fisher's equation will become key. And I just want to mention it without going so deep into it. We know that the Fisher's equation, see, you can express it in different ways. You can express it in different ways. I'm just giving a general expression. 1 plus n is the nominal rate, will be equal to 1 plus r, 1 plus r, I close this bracket, and you that 1 plus r, you multiply with 1 plus I. I denotes the inflation rate. So 1 plus I want to use this, the small I to make it visible enough. So 1 plus I, 1 plus r multiplied by 1 plus I. So if you are given nominal rate and the inflation rate, and they want you to compute, the real rate, are you able to do that? So where n represents nominal. I'm just reminding you guys, and I know this thing is important. R represents the real rate. Sometimes it is called real return or real rate. So either way, it is still the same, real rate of return. Then, which one? I. Now the I, what does the I denote? I now denotes inflation rate. So just make sure you put this at the back of your mind somewhere. It might become handy. And I think I've seen a question that is testing on this concept of Fisher's equation. So this will help you. And I want to leave it there. And I look at the discounting, project evaluation techniques. Now, when you talk about project evaluation in BDA, there are a lot of project evaluation techniques that you already know, but I just want to mention, just by mentioning, I'm not going deep, just telling you on the areas you need to focus on, because time is running out, and I've told you AFM is not wide. Once you look at those specific areas, you'll be good to go. Now, when you talk about project evaluation techniques, evaluating viability, evaluating project evaluation, let me just type the word project evaluation. When you talk about project evaluation, members, you already know. What I'm doing is just to remind you, already know. Project evaluation, you need to make sure you remember the NPV I've just mentioned above. It is one of the methods of project evaluation. And make sure you know there is profitability index. Remember the formula at the back of your mind. And now that we are doing BDA using Excel sheet, these formulas, you don't have to go the manual way that you used to compute them. But once you have, the background knowledge of it from the manual examinations you've done, using Excel formulas will be so easy to help you get them very fast. And then remember, there is IRR, internal rate of return. It's a project evaluation technique. There is payback period. And when I talk about payback period, also remember discounted payback period. That is also there, discounted payback period. Remember that is also there. So I've talked about profitability index, IRR, payback period, and discounted payback period. They will come in handy someday. Then, when we talk about NPV, remember there is also XNPV. You need to ask yourself, what is the difference between NPV and XNPV? They will help you. Again, when I talk about IRR, there is also XIRR. These are the areas that you need to focus on. These are the areas. Once you get questions that will test you on this, you are good to go. Do not stress yourself so hard. And you just need to remind yourself, how do we get the IRR? This IRR, IRR is the discounting rate when the NPV of a project is 0. So how do you get it? In BDA, they will test you that. They will test you about IRR and all that, and they want you to use the sensitivity analysis tools that BDA, that Excel is bringing onto you. And I believe that we are going to cover that. Now, before I don't want to waste a lot of time on that. That mentioning of these areas, I think that is enough. Let us get into this question and see what was the examiner trying to test us here. And you can see some of the things that I've mentioned here is what you are seeing in this question. This is just a model question. Yeah, it is a model question. And what I want you to focus on is not the name of the company, and it is not the figures. What I want you to focus on is what is the required part. Once you know how to compute a payback period, NPV, profitability index, and you know how to use a graph to get IRR, you are good to go. Whatever name they will bring to you in an exam, whatever figures, you do not even care about them. Whatever period, don't worry about all that. Worry about what approach am I going to give and am I able to answer it? Now let's see, members, and I hope we are together. Let's see how do we go about such a question. And I will read the question and we get to, this is a very simple question, members. It's very simple. Yeah, so I will read the question. Safari Limited is evaluating a project with the following details. And we have the initial investment there, residual value, year one project cash flows is given. Then we are told annual cash flow growth rate from year two is given as 10%. Project life is 5 years. You see, it's a very, very short question, and the required part is compute the following project metrics. 1, NPV. 2, no, 1 is the payback period, 2 is the NPV, and you've been given a discount rate of 12%. And I remember mentioning, whenever an examiner wants to hide discounting rate, just put this at the back of your mind, the Fisher's equation, and you will be good to go. Roman 3 is asking about profitability index, and they're telling you to assume also a discounting rate there of 12%. Then we are told to use a graph in part B to determine the project's IRR. All right. So members, someone is asking which question. I believe I shared this file in the WhatsApp group. I've shared it in the WhatsApp group, so you need to be able to grab it and we move together. So members, this question here is very easy, and you can also relate what is a payback period from your physical exam that you used to do. You just need to know what is payback period, and I believe you still remember that payback period is the amount of time it takes to recover the cost of an investment. That as simple as that, and I believe you still remember that statement. It's the amount of time it will take to recover the initial investment. That is what payback period means. So how long will it take for me to recover what I invested? Now, with that knowledge, we want to use Excel to get the payback period. Very simple. So I want us to start doing the working. I just want to answer here. So workings here, workings there. Now, the project we are given here is a 5-year project. Where did we get 5 years? We are told the project life is 5 years. So that's where I'm getting it. And you know that when investing, the start of a project, the initial investment is normally in year 0. So we start with year 0. Then we run from year 1. We go all the way to year number 5 because that is the project life, like that. So what I've done is just write the years. The next step is now to start putting the information given together. When are we investing? We are investing in year 0. That's where our initial investment will go. So I will say there, initial investment. Initial investment is in year 0. And how much did we invest? We are investing 100, or this company intends to invest 100 million. They intend to invest 100 million. Vic is not seeing the question. Can someone share the question even on this chat box? Vic, if you're in the WhatsApp group, then you should be able to have it, unless you are not in the WhatsApp group and you are not telling us, which is not a crime. But regardless, can someone please you can even attach it on this chat box so that he can be able to have it. He can be able to have it. Please, somebody do that so that we all move together. We all move together. Has someone shared it? Has someone shared it? For me to share it, I have to pull down my screen, and I don't want to pull it down. So someone please share it with Vic. I hope that Vic, confirm, do you now have the question? Have you seen it somewhere, Vic? Confirm very fast. I want to move. You have it? All right. Thank you, Nico and Alex. So Vic, are you now seeing it? Great. Thank you, guys. Thank you, BM. Thank you. Those are great people. Jaden, great people there. Thank you for sharing so that everyone is on board. All right. So members, what I've done, I'm putting a structure to the information given. Initial investment is in year 0 and the amount we are given is 100. Remember, when you're investing, that is an outflow. So allow me to bring the 100 million as a negative. 100 million like that. 100 million like that. 100 million like that. So when I bring 100 million like that, let me put the comma style. There you go. All right. So with that, that is the initial investment in year 0. Then we look at now the cash flows. Now we are evaluating a project. This company wants to invest and they want to evaluate and ask themselves, is this project viable? Are we going to get a positive return or we are going to lose? And they already came up with the expected cash flows, the cash that they will realize. And in year 1, they've told us that the cash flow is how much? 25 million. So we go straight ahead and say, cash flows there, members. And cash flow starts from year 1. The figure is here. I'm not picking it from anywhere else. We've been given the figure. So this 25 million, I'm putting it in year 1. Like that. So that is what they expect to receive at the end of year 1. That is 25 million. Yes. Now, after that, they went ahead and told us that the annual cash flow will grow from year 2. At what rate? At 10%. Members, we've already covered how to, the 2 approaches that you can use to apply the growth rate. I hope you remember them. One of the approaches which I had told you is you can add the 10% onto 100% to make it 110%. Then you multiply 110% by the cash flow that you are growing. That is the first approach. The second approach is where we are using the bracket one. 1 plus R. R is the rate at which it is growing. If the figure was decreasing, you would say 1 minus. But because the figure is growing, it is 1 plus. It is the same 10% plus 100. 1 in that bracket just denotes percentage. It denotes 100%. So that is the approach that I love. And again, I told you, you could type the 10%. If you're doing sensitivity analysis, you'll be required to have a column for the percentages so that whenever they change, you can also as well change the same. For example, when you have a base case scenario, best case scenario, worst case scenario, I believe you've also done the scenario manager scenario analysis in sensitivity. And I just hope that we'll also get a nice question that will test on the concepts comprehensively to help you in revision. For now, let's use the bracket approach, 10% growth rate, to see how much or the cash flows, how will the cash flows change as from year 2 to year number 5. We are told it is 10%, and you can all see the 10% was given there, and it is growing. So I will go to year number 2, and what will I do? Put an equal sign, open a bracket and say, it is 1 plus R. R is the growth rate, 10%. Now, when I open this bracket, I have 2 options. I could have written or typed the 10%, or I can simply refer to the 10% here. I could refer to this 10% here. But because I want to set my formula to autofill to year 5, I will be required to fully lock it. As at now, I believe all of us know how to log. We know what absolute referencing mean. We know what partial referencing mean, and we know what mixed referencing mean. Those are basic Excels that I believe you started with in this course. Now I will fully lock it using my F4 key. Then I close that bracket. And what do? I multiply it by the cash flow that we are growing. And remember, when we are in year 2, we are growing cash flow in year 1 by 10%. When we will go to year number 3, we are growing the cash flow in year number 2 by the same 10% because it keeps growing every year. It keeps growing every year. When we go to year number 4, we are growing the cash flow in year 3. And that is what the examiner told us. Because we were told the annual cash flow growth rate, annual, meaning every year it is growing by 10%, 10%, 10%, and you are growing what was in the previous year. When I go to year 5, it is year 4's cash flow that grew by the same 10%. Now, I would do that in the first instance. But for somebody who is wondering, why did I refer to this 10%? For that person who is wondering that, you don't have to refer to the 10%. You could as well go to the same approach, say 1 plus. And I said in this approach, this 1 represents 100%. And I will type in my 10% without referring to it. When I type it, I've already fixed it. It is not going to change. I don't have to lock anything in this case. Then I close that bracket and I multiply by the cash flow that I'm growing. When I do that, you realize I will get the same figure. That is also another approach. If you don't want to refer to any cell, just type the percentage change. So long as it's constant, you're good to go. Members, I hope we are getting it. Again, for that person who is wondering, what is this bracket approach? Please, you can use the other alternative. Which other alternative? Just add the 10% to 100%, and I will put an equal sign. If you add 10 to 100, what do you get? 110%. If you convert the 110% to decimal, what do you get? 1.1. So that person will just go and say 1.1, and then you multiply by the cash flow that you are growing, and you will confirm, you'll still get the same answer. So you choose whichever you are comfortable with. Members, I hope we are together. Allow me to delete those two. Now, once we have our cash flows we expect to receive for the next 5 years, then now we are on the trajectory, we are on the right path. And I hope we are together. Now, we are told the project life is 5 years, and that's why we have our years from year 0 when we are doing the investment all the way to year number 5. So this information here is already covered. We're already done with this information. We've broken it down and put it in an understandable way. So let's go to the required. You see, just with that information, we have everything we need to answer the question. So in that case, allow me now to go to the required part of it, And for someone who wants to put this thing, to have the net cash flows written here in a nice way, I will also just do the same. There is no harm. I will do that and say, let's look at the net cash flows. Remember, we are following on cash flows. When you invest, it is an outflow because you are spending money. The amounts you expect to receive, those are inflows. That's why they have to be positive. I'm seeing some chat here. Let me see what a member is saying. All right. Sue is saying residual value. Grace is also asking, how do we treat the residual value? Thank you. Thank you, guys. That's a very, very good observation. A very good observation because we were given residual value, and I think I missed seeing it, and that is a very good reminder. Thank you. So residual value, residual comes from the word residue. Or there is also another term called salvage value. So this is the value you realize, remember, when you want to replace or at the end of the project, you will sell off the assets that you're using. You will sell off your, if it is machinery, if it is any investment that you are using. If the project ends, I believe some of us can relate. There are those, NGO-funded projects that is maybe specifically to run in a specific period. When the period expires of that project, they will even dispose of everything. They will sell off their properties and all that. That is what we denote by the residual or the salvage value. Sometimes it is called scrap value. Either way, you are still referring to the same thing. Now, this residual value, when you sell these items, when you dispose of the items, in other words, you are selling to get money, right? Whatever you are getting is an inflow. And because it is the residual or salvage value, it comes at the end. So you will realize the amount at the end of the project life, because that's where now you are selling off. Thank you, Elo. Elo is reminding us and telling us that we added to year 5 as the total terminal cash flow. Thank you. And members, I believe we also agree. If you do not agree, feel free to critique. Feel free to tell us what you also feel. How much is it? I can see you are told it is 10 million. So they will realize 10 million. And this 10 million is an inflow. Remember, they are selling. So you are getting money in. That is an inflow. That's why it is positive. Now, if you look at the cash flows across from year 0 will be negative. But from year 1 to year 5, you are realizing inflows. So I will get the totals there. And when I use alt equals and then I specify the amounts, the rows that I'm working with, then I autofill to year number 5 and I have my net cash flows. Members, are we together? Because the next step now is very simple. I hope we are agreeable up to that point. Just want somebody to confirm. Very good, thank you. So members, what we are required to do is now to answer the questions. And I'm starting with question A. I'm starting with question A. And what does question A want us to do? Very good. Compute the following payback period. I told you what payback period mean. Payback period, very simple. The amount of time you will take or it will take you to recover the cost of an investment. How much have we invested? 100 million. Now, how long will it take us to recover this 100 million? That is payback period. Payback period like that. Payback period. How long will it take us to recover it? We want to use Excel and you can approach it in a layman's perspective. Now, we are investing 100 million for how long? For 5 years. So we ask ourselves, how long will it take us to recover this amount? There are also 2 approaches here, and I want to give you both of them. You choose whichever you are comfortable with. Elo has already given us an answer there, but we need to know how do we arrive at it, which is very important. There are 2 approaches. Approach number 1, what you need to do is just to list the years. For how long do you need to recover the money? You recover it in 5 years. So allow me to write here years. And remember, we are starting from investing. That is when we spend the money. That is the first approach. I'm giving you the first approach, then we go to the next one. And we are looking to recover it in the next 5 years. So from year 0 to year number 5, we need to be able to recover what we spent in year 0. And remember, we are looking at cash flows. What are you recovering? You're recovering your money. That's why I'm writing there cash flows. And how much did you spend? In year 1, you have spent this amount, 100 million. That is what you've spent. So you ask yourself, how long will it take me to recover this money? We already have the net cash flows projections for the next 5 years. The amounts we expect to be receiving. In year 1, we are receiving 25. In year 2, we are receiving 27. In year 3, we are receiving 30 to 50. And we are only looking to recover how much? 100 million. Very simple. So after how long? So we are going to introduce another column. We call it cumulative cash flows. Cumulative cash flows. That column we are introducing is going to help us to know after year 1, how much shall we have recovered? After year 2, how much shall we have recovered after year 3? So that we get to see after how long will we get the lump sum back of 100 million. So this approach, I normally see it as very simple, but I'm going to give you another alternative one. Good. So in year 1, how much are we going to, how much are we expecting? Because we are doing evaluation. How much are we expecting? This 25 million. I believe you know where we got the 25 million. In year 2, how much are we expecting to receive? 27,500. In year 3, how much are we going to use? How much are we expecting to receive? 30 to 50. I know someone is wondering, we've already learned advanced Excel. Why are you referring to this cell one by one? Why don't you use the transpose function in Excel so that you just get all these cash flows in a vertical alignment? That person is very right. We could use that transpose. But again, because we are not having so many cash flows to bring here, I could still do that. But though, once you have that knowledge of transpose, you don't need to go this route. So why don't we just use the transpose function? I would delete all that. We're just reminding ourselves some of these things, when you continue doing them, it will get to sink into your mind. What is transpose functionality? Transpose function will help us to rearrange whatever is in a row alignment, which is these ones, to bring it into column alignment. So instead of picking the figures one by one the way I started by doing, to stop wasting time, we could use the transpose. What does the transpose mean? I will highlight the range of figures in a row alignment, which I want to bring in this column alignment. And what I do, I use Control C. You can as well right click and choose on copy. This is the same thing. Then you are copying. Where do you want to paste it? I want to paste them here in a column alignment. But remember, there was a formula. I used Alt equals or auto sum to get the figures here to the net cash flows, and it is the net cash flows that I've highlighted, right? Now, meaning formulas are already there. For you to bring the figures here without interfering with the formula, and we can even as well do it, and you will see that it will not work if I just paste the figures without removing the formula. So how do you remove the formulas? Come to the home button. There is that paste down arrow, and you say, we're going to transpose, and remember, you need to transpose and bring them as figures without formulas. But let's bring them with formulas and you'll see what will happen. So let me just go and straight away transpose. You see what's happening? Do you see what's happening? Are these the same as this? They're different. The figures we have here are very different. Why? Because of the formulas. You see the formulas are still here. So whenever you want to use the transpose functionality, make sure you remove the formulas first. How do you remove the formulas? Let me undo what I've done here so that you get to see to bring the correct figures like that. For you to remove the formulas, I will copy them. I will still use Control C or right click and choose on copy. But then I want to paste the same. I want to paste the same here. But paste them as figures like that. I've removed the formulas on these net cash flows, and you can see there is no formula here. You could paste it on the same, or you could copy and paste it somewhere else as figures, but I don't see any problem even if I paste it on the same line. Then now from here, because I don't have formulas, I will copy, then bring them here by transposing directly without even worrying. And you can see all of them are there. The same cash flows. What I need to do is just to remove you see these lines that I'm having below each figure. I just want to remove by putting no border, and I have my cash flows already listed there like that. That simple functionality can help you save time, and I hope you've seen it. Now, our focus is to ask ourselves, how long will it take us to recover 100 million? Now, cumulative cash flows column is going to help us track down how much we are recovering at each stage. So, at the end of year one, what are we recovering? At the end of year one, we are not recovering anything. At the end of year zero, sorry, we are starting with year zero. At the end of year zero, Maria is asking, how do you remove the formulas? Maria, worry not. What I've done, Maria, on your net cash flows, just copy them. And then once you copy, you paste as values. I used Control C. Come to the home button. You will see the clipboard area. Under paste, there is a drop-down arrow. Click on it. Then you will see paste values. You see that? Paste values. Pick on the first one. You paste these values here without formulas. Once you do that, you'll realize that where there were values, now they're only just figures with no formula attached to them. So from there, you can now apply the other functions, the transpose function, and you get your cash flows done very well. All right. Dottie, I hope you've also seen it. Dottie was also asking the same, and I hope you've also seen it. All right. Now, at the end of year zero, we shall not have recovered anything because that's when we are investing. So I will put an equal sign, refer to the amount we are spending in year zero. We are spending in year zero, we are not recovering. And it is the amount that we are going to recover. So in this approach, this first approach, we are starting from what we are spending, then we start tracking down from year one. So at the end of year one, how much are we remaining with to recover? How much are we remaining with to recover at the end of year one? Now that is the approach of reasoning from here. In this approach, that is the approach of that is the way to reason. At the end of year zero, we are spending 100 million. But meaning, as we spend 100 million, we are looking to recover 100 million. At the end of year zero, our interest is to recover 100 million. At the end of year one, how much more do we need to recover? That's what you ask yourself. How much more? If we've spent 100, how much are we looking to recover? How much have we recovered? We've recovered 25 million because that is the cash inflow in year one. Now, how much are we remaining with? Put an equal sign, refer to the 100 million in year zero under the cumulative column. Then we add to 25 million the amount we are recovering in year one. Meaning we are left with how much? We are left with 75 million to recover at the end of year one. We've recovered 25. How much more are we looking for? 75 to make it what? 100. Yes. When we go to year number two, how much are we earning? How much are we recovering at the end of year two? We are recovering 27,500 in year two. But at the end of year two, we shall have recovered the total of what is in year one and total in year two. But in this approach, just look at it that how much are we getting in year two? We are getting 27,500. So at the end of that year two, how much more are we looking for? So to get how much more you are looking for, come to that cell under cumulative cash flow, put an equal sign. Refer to the cumulative cash flow at the end of year one, which is 75. We are looking to recover 75 million. It is in negative because we are looking to recover it. It is an amount we spent. It was a negative cash flow, but we are reducing it year by year because we are recovering part of it as we continue until we recover the whole amount. That is the payback period. So refer to the cumulative cash flow in year one. Then you add what we are getting in year two. In year two, we are getting 27,500. So that when I click on my control enter, at the end of year two, the amount that we are looking to recover is 47,500. You see, it is still in negative, meaning we are still yet to recover our 100 in full. We've recovered part of the 100, but we're still remaining with 47,500. In year three, how much are we getting? In year three, we are going to recover 30 to 50. 30 to 150. We are going to recover 30,250,000. But when we ended year two, we were still looking for 47,500. So when we bring on board 30 to 50, have you already fully recovered? We can all see that 30 to 50 is still less than 47,500, meaning we will take the whole cash flow in year three and we still remain with some amounts to look for, right? So what do? We are looking to recover 47,500, but we are bringing on board 30 to 50. So what do? We just get the difference, what we are looking for and what we are bringing. So this 30 to 50 will reduce 47,500 so that we see how much more are we remaining with to recover. I will put an equal sign. Refer to the cumulative cash flow at the end of year two. Then I will say, and the reason why I'm referring to it is because this is the amount we are looking for and it is in negative. So when I add the cash flow in year three, what I'm simply doing is deducting 30 to 50 from 47,500. Remember, this is a negative. A negative plus a positive is a negative. So I'm simply deducting 30,250,000 from 47,500,000 because we are recovering these amounts. This 3250 is an inflow. That's why I'm adding it. 3250 is an inflow. That's why I'm adding it. This 47 is negative because this is the amount we spent and we are recovering. So we are working with negative, the expenditure, and we are adding the inflows as we move from each stage to the next until our inflows will balance with the outflows that we spent. So at the end of year three, we are only remaining with 17 to 50 to look for. We have recovered all this 25 plus 27 plus 30. You see, we have recovered a total of, look at down here, total sum, we have recovered a total of 82,750. We are left with 17 to 50 to make it 100, to get back our 100 which we invested initially. Now, Look at the reasoning at year 4. We are looking to recover 17 to 50. But in year 4, our total cash flow will be 33,275,000. You see, you realize that the cash flow we expect to get in year 4 is more than what we are looking to recover. Our intention is to see what exact period are we going to recover the 100. Where are we having the break even? The break even mean our total expenditure will be equivalent to total amounts we are getting back. So if I add cash flow in year 1, year 2, year 3, and year 4, you realize that it is more than 100 million. You can see the total down here. It is 116 million. So the period we are going to recover our total expenditure or total investment will be between year 3 and year 4. We cannot say it is in year 4 because in year 4, we're going to get our 17, but still have a balance. And we want to get in year 4, how many months in year 4 are we going to get our 17 to 50? Because we don't need the full amount in the whole year to 33 to 75. No, it is more than what we need. We're only looking at 17 to 50. So this is the point where we have now to look at the payback period. How do we now compute it? It is very simple. It is very simple. So in this approach, you will say that our payback period will be, remember, we are taking full cash inflows, the whole of it in year 1 we took in full at 25 million. In year 2 we took the whole 27,500. In year 3 we also took the whole 30 to 50. But in year 4 we are not going to take the whole 33 to 75. We are not going to take the whole of it. We are not going to take the whole of it. We're just going to take a portion of it, a portion of that amount. So it is that portion that we're going to convert into period. So the full years we're going to recover our 100 million is 3. 3, I hope all of us agree. All the cash flows from year 1 to year 3, we're going to take all of them before we reach at 100. Then we're going to add the remaining portion. What portion? 17 to 50 that we are looking to recover in year 4. But I want to ask ourselves, in what period in year 4 are we going to recover 17 to 50? So we are taking a portion of cash flows in year 4, a portion of it. How do we get a portion of it? We get a portion of it by getting a fraction because we are converting it into period. So the amount we are looking to recover is 17 to 50, right? So I will either introduce a bracket, which I think is the most appropriate. We are looking to recover how much? 17 to 50, 17 to 50. Where am I getting 17 to 50? It is this amount that we are remaining to recover. I hope you are seeing it. And it is 17 to 50 as a fraction or as a portion of the total cash flow in year 4. I refer. Or because I started by typing the payback period, let me just type it in full. Then now we put it as a formula. It is a portion of 33,275,000. And then we will close that bracket at the end of it all. Now, this is how we are getting the portion or the fraction of cash flows in year 4 to recover the 17 to 50 remaining at the end of year 3. I hope we are getting it. So let me put it as a formula so that we get an answer. It is equal sign. It is 3 years. 3 years, we agree we are going to take all the cash inflows for the 3 years before we achieve our 100 million. Then we are going to recover our remaining amount of 17 to 50 from the cash flow in year 4. How much are we recovering? I open a bracket. We are looking to get the remaining 17 to 50 like that. And it is a portion or a fraction of which amount of this cash flow in year 4. So I just refer to it like that. I close the bracket, and when I hit on Control Enter, I'm getting 3.52 years. 3.52 years. It is 3 years, 5 months, and 2 days. 3 years, 5 months, and 2 days. That is the period we're going to recover our 100 million initial investment. Members, are we together? Did we understand? I just want some confirmation that somebody has understood something. All right, thank you guys. I'm happy that you've understood. because that is the most important thing. Thank you, thank you, thank you. Overwhelming, overwhelming. That's very good. So I think once you've understood this approach, you don't have to worry about anything much. I know someone will be saying, in some other quarters, we normally don't start with the outflow. We start just by tracking on the inflows, the amount we expect. You are still okay. So for someone who want to use another approach, you can still go with it. The most important thing in an exam is for you to arrive at the answer. Yes, unless the examiner wants to follow your steps. But in this question, the way it was asked, the examiner simply wants the payback period. The examiner really does not care on the approach you'll use, where you'll start, whether you'll start with year 0 or you start with year 1, the examiner really does not care. So for that person who wants to start from year 1, you are still okay. You are still okay, and we are still together. So for that person, for the sake of that person, I will just start and bring them here. And I will say that these are the cash flows. These are the years. And then these are the cash flows. And then I will also bring on board cumulative cash flows. Cumulative cash flows, just for the sake of that other person, because I normally like to put on board, to make sure that all of us are moving together. So for that other person who wants to, who normally is used to this approach, it's okay. Where you start from year 1, the reasoning will still be the same. Nothing different from this approach of where you're starting from the initial outlay. So when you take this approach, now you should remind yourself, how much are you looking to recover? It is 25. It's 100 million, right? That is the amount you're looking to recover, because that is the essence behind payback period. Now, you still use the same cumulative column to help you see how much have you recovered at what stage. You will put an equal sign, and the cumulative at the end of year 1 is 25. So cumulative in this case means the total amount that you shall have realized at the end of every period. So at the end of year 1, you shall have recovered 25 million. At the end of year 2, the total you shall have recovered is the 25 in year 1 plus 27,500 in year 2. You shall have recovered a total of 52,500. At the end of year 3, you shall have recovered a total of what you got in year 1, what you have in year 2, and now what you are bringing on board to get in year 3. So you are picking the total at the end of year 2, and then we are asking ourselves, how much are we getting at the end of year 3? You say, at the end of year 3, we are bringing on board 30 to 50. So like that. So at the end of year 3, you have recovered a total of 82,750. That is now the reasoning. And when you reach here, you ask yourself, if I go to year 4, am I recovering my 100? And when you try, add what you have at the end of year 3 in total, then add to what you are expecting in year 4, you realize that you have surpassed your target. You're going to get more than what you're looking for. You see that? You are going to get 116,025. But what was your target? You are looking to get only 100 to recover. So you don't need to pick the whole cash flow in year 4. You just need a portion of it. So the question is, what portion of the cash flow in year 4 are you looking for? So instead of getting the total cumulative at the end of year 4, look at what portion am I looking to recover at the end of year 4, because I'm not able to pick the whole cash flow. I just need a bit of it. So in year 4, how much do you need? In year 4, you just need the difference between your initial investment, which was 100 million. 100 million, is this 100 million? This is 10 million. I had another 0. You're looking at the difference between 100 million and the total that you already have. How much do you have already? 82,750. So how much more are you looking for? You're looking for 17,250. This is what you're looking for. And if you add this one, you realize the total of this will be 100, because you are starting from year 1, year 2, year 3. Then onto it, you add what you are looking to recover in year 4. You see the total down here? 100. Total cash flow in year 1, total in year 2, total in year 3. But in year 4, you are not taking 33. You only need 17 to 50. That will give you 100 that you are looking for. So when you reach at this point, then now the reasoning that we gave here is the same thing that you are doing here. Yes, you are simply doing it by saying, I'm going to take the whole of your 3 years cash flow, in total, all of it. Then I'm only taking a portion of year 4's cash flow. Which portion? I'm taking 17 to 50 out of 33 to 75. So I will still open a bracket and say, I'm looking for 17 to 50 out of the total cash flow in year 4. I close my bracket and I realize that I'm still getting the same period. You see, this is just decimal places. If I reduce it to 2 decimal places, I will still be having the same payback period. So for those people who wanted to go with this approach, you can still go ahead. You're still going to arrive at the same answer. I hope we are together. I hope that is all okay. Let's look at what we need to do in part B. In part B, that is Roman 2. Let's look at Roman 2 there and see what we are required to do. The net present value, and we are told to assume a discount rate of 12%. That is very easy, part B. Very, very easy there, members. So in part B there, we are going to do NPV. And I already wrote what is NPV. And I will just even remind you, NPV, from what we wrote here, this one here, NPV is the present value of cash inflow minus the present value of cash outflow, which sometimes you can call it initial investment. To put it in words, you can say NPV is the difference between the present value of cash inflows and outflows over a period of time. The difference between the present value of cash inflows, which we've denoted by PVCIF, present value of cash inflow. The difference with the outflows. Outflows is the initial investment over a period of time. Of course, you still remember I gave you a formula, and I told you when an examiner hides the interest rate, that is the discounting rate, you can still compute it. In most cases, they love bringing you the nominal side of it and the real rate. So with the Fisher's equation at the back of your mind, you are good. You are good to go. All right. So from here, let's get to see the NPV. And NPV, we're going to use Excel. And I just want to borrow from what I've written on the other sheet, the same formula. So NPV, like I've just written, is the present value of cash inflows. We're just getting the difference between the inflows and the initial. Allow me to just write initial investment instead of present value of cash outflows because they mean the same thing. So NPV, we're going to use the Excel formula because there is an Excel function of NPV. So this one, there is no hassle. Just put an equal sign, type NPV, and you will see the formula showing there. And you can even see a brief description. They're saying it returns the net present value of an investment based on a discount rate and a series of future cash flows. You see that? Very simple. So once I type that, you pick the formula. How do you pick that formula, that function? You can either double click on the function that is already highlighted in blue if that's what you want. If I did not want NPV, I will use my down arrow to go to XNPV. And by the way, as we have these two functions here, I mentioned XNPV besides NPV. You need to know the difference between XNPV and NPV. So if I go back to my up arrow, you will see that the formula that you want to pick should be highlighted in blue. Then how do you pick it? You can either double click or use the tab key. Personally, I love using tab. So if I use tab, I already pick the formula. But for that person who likes double clicking, go ahead, you are still picking the same formula. So long as it's the right one, which is highlighted in blue. My highlighting is in blue. I don't know if yours is also the same blue, but the one that is highlighted in a certain color. I don't want to cast the blue on stone. Maybe the version of your Excel brings it in a different color, which is still okay. So NPV, you will see a description of the functions of what you need to feed into that function to get an output. The first one is rate. Rate is the discount rate. The discount rate. That is the cost of capital. If it is not written in a certain cell as the percentage given, in our case, we were told it is 12%. You see, 12% is not appearing in any cell, right? 12% is in a range of letters. So we cannot refer to it from here. But there is really no problem. You can as well go and type it in. I can as well go and type 12% like that. No one will penalize you for doing that. Then you put a comma and you will see it will be asking you value 1. You see value 1 here. It is asking you the next value. And because we are following the function, the formula for NPV, present value of cash inflows. What are cash inflows? The amount we're going to realize from year 1. So come to year one cash flow. These are the inflows because you can see they are positives, right? So we pick on the inflows and we are picking the total net cash flows under inflows from year one. So I will pick the range from year one to year number 5 like that. Just highlight the range. Excel will highlight and pick all of them for you. That represents the values that we are looking at. Now, that will give us the present value of cash inflows. And of course, following our NPV formula, we are getting the present value of cash inflows, then we compare or we deduct the initial investment. So I will put a minus initial investment. Now, what is our initial investment? 100 million. Now, if you want to refer to this 100 million directly on this cell, please check on the signs. If I refer to 100 million at this point, remember, I've typed on a minus, right? And this cell also has a negative. What am I doing in essence? I'm adding 100 million, but I should deduct. Because of these signs, please be careful of the signs. If you want to use the minus so that you are confident and be able to see that, actually I deducted initial outlay. Please, no one will beat you or penalize you if you just type your 100 million like that. No one will penalize you for that because you're still going to get the same answer. Yes, and I will confirm by control enter and I have my NPV. No one will penalize you if you type it. But for that person who does not want to type it in, you have to be careful of the signs. So for that person, if I delete the 100 million, if you want to deduct negative 100 so that it is actually deducted, you will now use a positive sign so that when I refer to this, the positive sign multiplied by the negative sign, the outstanding will be negative. So I'm deducting 100, though I've written positive, but I'm deducting. I hope members you are seeing that. It will be very sad in an exam if you know what you are doing, but the only thing that makes you to fail is the sign. Please be careful of the signs. If you're not sure, just type the figure. You'll be safe, the one I did first. So if I do this, you'll realize that I'm still getting the same NPV even when I typed 100 million. So we've deducted it. However much I've written a positive, but because there is a negative here, it is still deducting. That is how we get the NPV. And I hope no one should have a problem with computation of NPV. Confirm to me that we are all okay. We do the Roman 3. The Roman 3. Are we all good up to that point, members? Are we good? Are we good? Are we good? Are we good? Very nice, very nice, very nice. So members, we should move to Roman number 3, profitability index. And because there is something interesting in profitability index, there is something interesting in profitability. Okay, very good. Very, very good. There is profitability index and then there is IRR using a graph. IRR using a graph. So members, maybe you can take 2 minutes, 2 minutes break, have 2 minutes break, then we pick it from there by 6:15. That is 3 minutes actually, not even 2. So you can have 3 minutes. You can put your head outside in the cold a bit, but do not go horizontal, members. Do not go horizontal. That position is very dangerous at some time. You can be tempted. You can be tempted to sleep. Yes, I've talked about to sleep. Yes. So 3 minutes, we are coming at 6:15 to resume. All right, it starts now. What if we get a profitability index which is exactly equal to 1? What is the decision rule there? Viable. Grace, are you sure? Break even, okay. Because we've said if the profitability index is greater than 1, then it is viable. If it is less, you reject the project. What if it is the same? Point of indifference. Jaden, is it really a point? All right. Yes, H is giving us the correct thing. It is indifferent. Indifferent. Yes, Jaden was thinking the right direction. That is okay. You can accept or not accept. Yes, that is also true. Elo, that is a very, very good one. It is neutral. Break even, not generating any value. Okay. So when it is 1, it is indifferent. You can either now decide to accept or reject, but it is not outright whether you need to reject or to accept. It is indifferent. It is neutral. Yes. So you need to just make your own decision and judgment when you come to such a case. Now, We've said profitability index, very simple, the same way the members you've already said. I'm just going to follow the same thing without going to different thing. Present value of cash inflows. We are comparing the present value, the ratio of present value of cash inflows, the ratio to the initial outlay, which is also called present value of cash outflow. But I will just write initial outlay like that. So with that, members, how do we get the present value of cash inflows? We are going to borrow the formula for NPV to get the present value of cash inflows. I told you when we were doing NPV and said, when we stopped the NPV at this point, this formula at this point, this only gives us the present value of cash inflows. But if we when we went ahead and also compared it with the initial outlay, then we were getting NPV. But now we're going to borrow the same formula of NPV, but we are using half of the formula to get the present value of cash inflows. Then we divide by the initial outlay now. In NPV, we are deducting initial outlay. In profitability index, we are now dividing. I hope you're getting the difference. So just put an equal sign and type NPV because it's the formula we are picking. The interest rate or the discounting rate we've been given here, it is 12. You can see it? Yes. So if it was written in a certain cell, you would refer to it, that rate. But because we did not type it anywhere, there is no harm even if you type 12%. Put a comma. The values are the inflows. Remember, please do not pick on the outflow. We are picking on the inflows, the range of the inflows like that. Then, when we stop that formula at that point, we are simply going to get present value of cash inflows, and that's what we need. After you have the present value of cash inflows, then now you divide by the present value of cash outflow or the initial outlay. So I will divide directly there. And what am I dividing it with? The total initial outlay. You see the negative 100, but also take note of this. Whenever I'm referring to the outflow of 100 million, I need to remember that it is in negative. So the question is, do I need it in negative in this my formula? The answer is no. I need a positive 100 million. So if I have to refer to this cell, let me cancel out the negative by introducing another negative here. Then I refer to the 100 because I need the 100 to be positive. But if I don't want to go to this longer route, I can simply put that division sign, then I type 100 million. I just type it manually. But because I want to refer, I have to start with a negative to cancel out the negative so that I have positive 100 million. I hope you are getting that. So this formula here will now give us profitability index, and control enter gives me an answer there, and I'm seeing my profitability index is 1.13. And because of the decision rule that we have discussed, if it is greater than 1, then the project is viable. If it is less than 1, you reject the project. If it is equal to 1, then now that is an indifferent decision. It is indifferent. You can either reject or accept because the profitability is the same. But in this case, it is viable. All right, we are going to part B of this question, and we are being told to draw a graph. What are we determining by the graph? IRR. Can somebody please remind us, what is IRR? You know, we've been doing this approach of trying to remind ourselves of what is payback period, what is NPV, what is profitability index. Now, what is payback period? Now we are coming here to say, what is IRR? What is IRR now? I think I had mentioned it at some point, but it's also good to just know what we are dealing with so that when we apply the formula, you already have a reference point. What is IRR? Grace is saying NPV equal to 0. Grace, you are very correct, but why don't you put it in words, Grace? The rate of return at which NPV is 0. Thank you, Mika. I hope we are all agreeing that that is what IRR stands for. IRR is the discount rate. The same way the two members have given is the discount rate that, that makes the NPV of all cash flows to be 0. So the rate of return when NPV is 0. So let's come. But now we are not supposed to do it, we are not supposed to just compute that IRR like that. We are going to use a graph. You should know, and you should remind yourself and know that There is an Excel function of IRR. So let's come to part B. You need to know that there is an Excel function of IRR. But in this case, the examiner did not want you to use Excel function. They want you to use a graph. But now what I want us to do, I want us to do both and then we compare, right? So what is the IRR function? Put an equal sign and just type IRR. There will be an Excel function that will show there. And you can see a description given. It returns the internal rate of return for a series of cash flows. Very simple. Yes. So we can use that IRR function. Then we are going to draw a graph and we compare if we're going to get the same output. So I will pick my IRR function using my tab key. I told you you can use tab or you can double click on the highlighted function. And I also want to remind you, make sure you know that there is also MIRR. MIRR. Then there is also XIRR. I mentioned XIRR in that initial, when we were introducing this, but also there is MIRR. You need to know the differences. Returns the internal rate of return for a series of periodic cash flows. Periodic cash flows. Yes, so you need to remind yourself, and it is periodic cash flows considering both the cost of investment and interest on reinvestment. That word reinvestment is very important there. That is MIRR. When you come to XIRR, it returns the internal rate of return for a schedule of cash flows. But for now, I'm not going to those other two. But there is a question that we will look at that will test on those. For now, let's look at IRR. I will pick it by using tab key. Now you see, I want you to look at a difference. We've used NPV function. And in NPV function, it was written value 1, value 2, like that. But when you come to IRR, it is just written values. You see the highlighted function that we need to enter? Written values. Values mean you are picking the cash flows, whether they are inflows or outflows. Pick them across the board. We are picking values. We are not picking the inflows. We are not picking outflows. We are simply picking values. Please remember that. So the values we are picking is all the way from year 0 all the way to year 5. From year 0 to year 5. Those are values. Whether they're inflows or outflows, we don't care. We are picking values. Please remember that when using IRR function. Then, whenever you get any function given within a function in bracket, any entry that is required in a function and it is given in a bracket, that entry is not mandatory. So, you see it is values, comma, then there is a bracket written guess. You see that guess? If I put a comma, you'll see the guess is highlighted. We don't have to guess anything here. And this function is not mandatory. So you can either just leave at that point, click on enter, or you can close the bracket. Even if you don't close that bracket, Excel will do it for you and it will not bring you any error message. You can close it or just hit on enter. So for myself, I will just hit on control enter. And you see, I have my figure, 17%. I can even maybe increase the number of decimals to 2 decimal places. And you see it's coming to 16.75. And do you know why I'm increasing the number of decimal places? I'm increasing the number of decimal places so that they be 2 and not have a whole number, because we intend to draw a graph. In a graph, you don't have absolute figures. In a graph, we normally use estimates. There might be some decimal places in a graph. So I'm just giving that provision. And someone is asking, do we include the initial investment in the values? Yes, H. We just said that in this function, it is just telling you values. I want you to compare with what NPV is saying, equal to NPV. I pick the formula. You see, it is rate. We were using 12%, then I put a comma. Look at that. Look at how the NPV formula brings it. It is telling you value 1, value 1. Then you'll realize that value 2 and value 3 are in bracket, right? We did not go to value 2 and value 3. Whenever you get a function, you get anything brought in parentheses within a function, those are not mandatory. You don't have to key in anything for those ones. If you have, yes, but if you don't, there is no problem. That formula is still correct. You see it is value 1. Value 1 means the NPV function is specific. Are you dealing with outflows or inflows? So in our case, on computing NPV, we picked on the inflows only, not the outflow. I hope we are together there. So please get it right. In IRR, you pick on the values across from outflow all the way to the end. Yes, yes. Admin is getting a different answer. Admin should not get a different answer because once we have all the values from outflow is 100 and all these inflows are the same as what is showing in my screen, then you don't have a reason why you should get a different IRR. You don't have a reason at all. Because you know what I've just done? IRR formula, then I've just highlighted on the figures and that's it. That's it, nothing else I've done. I hope that your different figure is not the one that is appearing as a whole number. If it is whole number, just increase the number of decimal places. If you are getting 17, you are still correct. You are still correct. What I just did was to increase the number of decimals to 2. That's why it's coming to 16.75. Yes, Liaka 17 is correct. It's very correct. Yeah. Oh, thank you. Thank you. Admin has seen it. Thank you. Now, how do we get the same IRR, but now using a graph? How do we get the same IRR, but now using a graph? Now, this is what the examiner wanted you to do. What we have done is our own making. We were just trying to come up with our own because we know there is a function of IRR, but the examiner really wants you to use a graph. So how do we use a graph to present our IRR? Now, I will refer you to the definition of IRR. IRR is the discount rate when NPV is 0. That is the basis that I want us to remind ourselves and think of when we are drawing this graph. Remember, a graph has two axes. A graph has x-axis and a graph has the y-axis. So in essence, you must have variables in the x-axis and you must have variables in the y-axis for you to draw a graph. Now, reminding ourselves of what IRR means will help us come up with these variables. Members, that is the reasoning that I want you to approach in case you get such a question in an exam. When an examiner will be testing on discounting on project evaluation techniques, they love this part. They really love this part of find IRR using a graph. They love it. If an examiner is to bring to you anything to do with project evaluation, payback period most likely to come, then NPV is always very basic. Then this one, IRR using a graph, this one, I mean, any examiner setting on this area will bring this one. So please be guided. So we've just said that IRR, internal rate of return, is the discounting rate when NPV is equal to 0. I'm typing it in here because I want you to see it clearly. And I've also told you, to draw a graph, you need both x-axis and the y-axis. You need both variables. You need variables to appear in all those axes. Now, with this description here, which variables are we dealing with? Which variables are we dealing with? One of the variables is the discount rate. You see this? Is the discount rate. That is the variable that we are dealing with, number one. That is variable 1. The other variable we are dealing with is NPV. That is another variable that we are dealing with. I hope you are seeing it. In the definition of IRR, we have two variables, discount rate and NPV. Those are the variables that is going to help us to draw this graph because a graph must have this axis. So in that case, which variable do you think should appear on the x-axis? Out of those two variables there, somebody tell us. Which variable do you think should appear on the x-axis and which one should go to the y-axis? So that we have that point of intersection where NPV will be 0. Somebody? Which variable do you think goes to the x-axis? Here, we have two variables. Somebody saying NPV should go to the x. Discounting rate x. Okay, discounting rate. All right. I will agree. User is saying x-axis is NPV. All right, I see we have two different views here. NPV should go to y-axis. So I will agree with those members who are saying that the discount rate should go to the x-axis. And then, yes, I see Doro, Mika there, Grace, LJ, user. Grace is there. All right, admin is also there. Okay, so I will agree with the members who are saying that discount rate should go to the x-axis. So I will agree that discount rate should go to the x-axis. And then the NPV should go to the y-axis. So once we have that, then now we can go ahead. Why is my cursor not moving? NPV. We go to the y-axis. Once we have that, now let's get the range of these variables. Let's have figures for the variables. Now, when you're drawing this graph, our reference point should be the computation we already did. Remember, NPV, we already computed NPV up here. You see it? Discount rate, we already given the 12% that we used. But we are going to look at that discount rate when NPV will be 0. So I will type here NPV because that is one of the variables we are dealing with. Then I want us to come up with a range of discount rates. And we already know the discount rate that we used for NPV was 12%. You remember this? 12% we were given. And it is even in the question here, 12%. You see, profitability index, 12%, NPV was given 12%. So we want a discount rate that will come up, that will bring us a normal graph, a normal curve. So we want a discount rate before we reach 12% and then after 12%, so that we have both sides and so that our graph can appear normal. So we have figures below discount rate that was given and figures above it. So we can start even, for example, from 8%. We can even start from 8% because our discount rate that was given was 12. So we can start from 8% and we go even above 12. So we can take from 8%. We can even go up to 20%. There is no really problem. We know that our NPV was here, right? And we have figures before the NPV and then figures after the NPV. So we are looking at that point when NPV will be 0. Remember, at 12%, what was our NPV? We computed it here. At 12%, our NPV was 13 million. So we've chosen on 2 discount rates before. We can even start from 6%. I can even start from 6% here. So that I have at least 3 above, and at least 3 after. We can even have 3 or 4. We can even start from 1% if you like, but I'm just managing my range so that I have good, maybe 3 before, and then these others after, the 12% where we had our NPV. Now, from here, members, let us, because I want us to see, I want us to check and compare. What is the NPV when the discount rate was 12%? We already had it here. But even though we did not have 12% written on a different cell, we wrote it in our formula. You see the 12%, but we can still write it in a cell somewhere. I can put it somewhere here and say, where do I put it? Where do I put it? Let me just introduce another cell there and say R equals to 12%. That was the discount rate. What I'm just doing, you see the net present value that we computed. We computed it here and we typed the 12% manually here. What I'm doing, I just want to type the 12% somewhere so that we can refer to it. But really, we don't have to do that. But I'm just typing it in there so that we can get to interconnect these cells. I want us to just interconnect them so that we get to see the impact of the 12%. But really, we don't even have to do that. We don't have to do it. Because I know someone will ask, why didn't we start by typing it in on a different cell straight away? Why are we coming back to change it? No, I'm not. We don't have to. I just wanted to bring it on board, but I don't want confusion. So let's just do it here. Now, to get the NPVs, here, we know very well that we already computed our first NPV using the discount rate of 12%. But the reason why I felt like we need to do the discount rate of 12% in a separate cell is to interconnect these cells, because I want us to use, there is this sensitivity analysis tool that I want to use. I want us to come to this sensitivity tool under the data tab, the what if analysis. And then we use data table. We are going to use data table. And to use data table, you need to have your formulas interconnected. to have an output that is interconnected so that whenever there is a change, you will see it being detected. That's why really I typed in the 12% here. And what I'm changing is not much. I'm just referring. Instead of typing the 12%, I'm just referring to that cell. And you'll see the output is not changing. The output is not changing. Yeah. So this is the discount rate that we were given. I didn't bring in anything new. This one we were given. So that's what I've just referred to. Then when computing also profitability index, we typed in 12%, right? So I will also still just refer, and it does not change our answer. Our answer remains the same. When doing IRR, we did not need any discount rate. We just highlighted the values. Now, let's come here. Refer to the NPV that we had computed here. Just refer to the NPV and bring it there. Once you refer to the NPV, how do we auto-populate? How do we auto-populate NPVs, NPV at 6%, NPV at 8%, NPV at 10%, NPV at 12, NPV at 14, like that? How do we populate the NPVs with this tool called the data table? How do we populate using data table? How do we populate it? Yes, Carol, we are using data table. How do we populate it? Now, to populate that using the data table is very easy. And I want you to remind yourself, there are two types of data table. There is one tail or one variable data table, and there are two tail or two variable data table. In our case, are we dealing with one tail or two tail data table? Is it one variable or two variable data table? It has to be one or two. It cannot be more than two. It cannot be more than two when you talk about data table. Aha. All right. I see Doro, Sue, and Grace and LJ saying this is a one tail or one variable data table. I agree. This is one variable data table. So I will highlight the range, the two columns, without highlighting the title. Please also do that on your end. Do not highlight the title, written NPV. You see the NPV written there? Do not highlight it. Just highlight the empty row on top of the rates, of the discount rates that we have, and then highlight the NPV that we referred to. And make sure you refer to that NPV. Do not type it. Refer to it. And you highlight the whole range. Once you've done that, go to the data tab on your Excel window. Go to the data tab. You see the data tab here? Come to it. It is next to the formulas, data. Then once you go to the data tab, go to the forecast section where it is written what if analysis. Click on the down arrow. You have three tools: Scenario Manager, GoalSeek, and Data Table. Our interest is on the data table. Please click on the data table. You'll see a pop-up window. You will see a pop-up window. Written data table, there is a question mark, and they're giving you two empty cells: row input cell and column input cell. Row input cell and column input cell. Then I would want somebody to tell us, we've said that this is a one variable data table, meaning we are only going to choose one alignment, either a row input or a column input. So somebody to remind us, because this is not a new concept to us. Somebody to remind us. Once you've done your advanced Excel, this one now is not a new concept. Somebody tell us, which cell are we using? Is it row input or column input, and why? Yes. Grace is saying column. Caro is saying, Doro is saying column. Why? Why? Because someone needs to understand. Because this is where people go wrong. You reach here and you don't know which one to input. Somebody goes to row when you need to use column. Somebody goes to column when you need to use row. So what is the reference point? What are we looking at to advise us on the alignment? This is very important. Column due to 12%. So, which 12%? What if somebody has a question where there is no 12%? Where will they refer to 12%? Yes, where will they refer to 12%? Because we are borrowing a concept that you need to use everywhere else. So what will advise you on the alignment? Doro is saying, because our rates are in a column. Thank you. Alan is saying, we are varying the percentages. Thank you. LJ, columns because the rates or the variables are on the column. I think, members, we are understanding that, and I agree. Thank you, members. You see, What will advise you is the variable that is changing. The variable that is the alignment of the variable. What is the alignment of our rates? You see the rates are aligned in a column. We are going to also do the same computation when our rates are aligned in a row so that you get the difference. If you'll get the same output or you will be wrong. Now you see our rates, we've aligned them in a column from 6% to 8 all the way to 20. They're in a column arrangement. So I will choose the column input cell. Now somebody also tell me, after I click on column input cell, what am I bringing into that column input cell? Somebody needs to understand. And I just want to confirm if all of us are on the same page. Yes, it is in column arrangement. We've agreed the variable that is changing is the rate. And what is the alignment of the rates? They're in a column. So what next? What do I put in this column input cell? What am I inputting here? Because I could as well type anything. You see, it is typing, it is agreeing. I can even type anything there. So someone will ask, do I type 1? Do I type 12 that we are talking about? Yes? Do I type the IRR which you computed using the Excel formula? Do I type the 16.75? Because it will accept to type. What am I putting into that cell? Very important to know. Let me see what someone is saying there. Rate. Some is saying rate. Which rate? Mercy is saying refer to R value. Doro is saying refer to the discount rate used to get NPV. Thank you. Thank you. And members, I believe, for those who are also wondering, what are we inputting? Now you are getting it. Yes, Grace, we are referring to the cell with 12%. So members, once you reach here, you already know the alignment of the variable. Whatever you are inputting here is the rate the discounting rate you used to compute this NPV. Remember, our NPV that we referred to here, we computed it using some discount rate, right? And that's why I went ahead and wrote the discount rate in a certain cell so that we could get an easy way to refer. That's why I was bringing this concept. That's why. I hope now you understand. That's why I was bringing the 12% in a cell on its own, so that there is an interconnection with the formulas. We are telling Excel, please borrow this formula and compute for us NPVs. Borrow that formula. You see the NPV that we computed using that? Please borrow the same formula and populate our NPVs for all this range. Once I do that and I say, okay, we will get NPVs across. Members, I hope we are getting it. All NPVs are here. I just put a comma style, home button, comma style, and we have NPVs from 6% to 20%. And I hope, members, we are okay there. I hope we are seeing the figures that we have. I hope we are seeing the figures that we have. Now, from this, and you know what I'm wondering? There is something I'm wondering. Why did we move from 6% to 8% to 10%? Where is 7? Where is 9? Where is 11? Where is 13? I don't know how I came up with these percentages with skipping. Somebody saying sijapata. No worries. Cynthia, I'm going to repeat. Don't worry. Don't worry. Don't worry. Don't worry. I can even delete all that again. So Cynthia and any other person who has not understood. When we want to compute IRR using a graph, it is very simple. One thing I've told you, and I believe you also agree, that a graph must have x-axis and the y-axis. We've identified using the definition of IRR that the two variables is discount rate and NPV. I hope that one we agree. Yes? Do we choose 12% on list or on the initial cell? H, please also get it again. Now, when we've identified the two variables, the variable 1 is the discount rate. The variable 2 is NPV. So NPV I've written here. The second variable is discount rate. Yes? Now, to draw a normal graph, we must have a range. To draw a normal graph, we must have a range. To draw a normal graph, we must have a range. What range am I talking about? I'm talking about a range of the discount rates. We could even start from 4%, like that. We could start from 4%, we go to 5%, all the way to even 25 if you want. We can have as many, by the way, we can have as many. Because if you want a good graph, it must have both sides completely closed off. Figures below, before the discount rate that was given, we were given 12%, right? I've started from 4%, all the way from 4 to 12. This is what we were given, but I'm starting all the way before. And I'm also going past the 12, all the way from 12 to 25. So our graph will really appear very normal and it will be very visible. This is just to improve the visibility of the graph. Even if you maximize, it will be very big and you can see it clearly. Then what I've done here is very simple. We are using a tool called data table. We are using a tool called data table to get NPVs for all these discount rates. Mark you, what was the definition of IRR? Is the discount rate when NPV is 0. So we want a discount rate. We still don't know which one, but we have an idea. You know why we have an idea? We used Excel function to get our IRR, which was 16.75, right? So where we have 16.75 is around here, So this is where our IRR should fall. But we still can't tell because we need a graph that will show that. We know our IRR, but we need a graph to show this thing here. We need a graph to show it. So at 16.75, that is when NPV is 0. So we need an NPV to change from a positive figure at 16% to negative figure at 17, so that it is transitioning from 0 to negative. 0 to negative. When you move from 0 going backwards, it is negative. From 0, you go to positive. I believe, members, you're understanding the matrix there. So what we used is the data table, and this is how to use the data table. Make sure you refer to NPV. Refer. You see the NPV that we computed in A Roman 2? You refer to it. You bring it there because NPV is one of our variables. Then you highlight the range of variables all the way. I've highlighted, I should go to 25. So let me highlight all of them to 25 like that. Then go to the data tab. Do not highlight the title. This rate and discount rate and NPV, you don't need them. Just need the NPV value that you referred to. Then the cell above the discount rate should be blank. You see this cell here? Let it be blank. That one has no problem. This one is blank. It has no problem. Do not start typing the discount rate from above. No. Leave a blank cell on top of the discount rates. And then on this other side, have your NPV that you referred to. This one which we did in Roman 2 above. Then go to the data tab. Then click on what if analysis. Go to the data table. You'll see the pop-up window. And I believe you still remember the reasoning. The alignment, to know whether it is row input or column input, is to ask yourself, which variable is changing? The variable that is changing here is discount rate. What is the alignment of the discount rate? Is it in a column or in a row? We've agreed the discount rate is in a column. This is column arrangement. If it was this way, then it is a row arrangement. Like our cash flows here, you see, our cash flows are in a row arrangement, but these discount rates are now in a column. Please go to column input cell. In the column input cell, do not refer to 12% in this column here. Refer to the 12% we used to compute this NPV. So I will go to our NPV, and the 12% that was used to compute it is what I'm referring to. Then I click on enter, which is okay. Then I'm having the NPVs auto-populated for me for all the discount rates that I came up with, that I chose. I put a comma style, and these are the NPVs. And this is the interesting thing I was telling you. We used the IRR formula and got our IRR at 16.75. If you come to where we have a discount rate of 16.75, it is between 16 and 17. And for sure, you will agree that our NPV moved from positive, went to negative in between, next went to 0 in between, then to negative. And IRR should be the discount rate when NPV is 0. So this range alone cannot tell us the IRR. It only tells us where it falls. It is between 16 and 17, though we already know it is 16.75, but we need a graph to show this. How do we draw the graph? How do we draw the graph? Very simple. We use the same values to draw the graph. Now, because these are having formulas, you see we have formulas here. These are having formulas here. We do not draw a graph where there are formulas. Please remember that. We can do it, yes, but we don't need a formula to draw the graph. So we have two options. We have two options. And the option that I will ask you to go with is to remove, but again, we don't have to remove even the formulas. We can still work with the same. I can just write discount rate. If I interfere with this cell, we have NPV. Let's see if it will change any of these figures. I type the NPV. You see? You see what has happened? That is what I was avoiding. Because when drawing a graph, you don't need a blank space. You do not need a blank space. So that's why I would advise, let us copy where we have this formula so that we don't interfere with our computation. We copy it and then we paste it as values. Paste it here as values. Come to the paste, down arrow, then we paste as values. So from here, even if I deduct, or even if I remove that figure for NPV, then I rearrange this. I write here discounting rate like that, then I have no problem with that. So from here, when you want to insert a graph, to draw a graph, you need to highlight all the rates. But now you see our discount rates have come in as decimals, but we need them to be in percentage. So just highlight them, come to this cell, this part, so that we choose the style as percentage. We have them in percentage. Then we highlight everything like this to the end. Then after highlighting, go to insert. What are we inserting? We are inserting a graph. We are inserting charts. Come to this all charts here. Then Excel will give you recommended charts. You can choose whichever. So long as we know at the back of our minds, IRR is the point at which NPV is 0. And given the alignment, you see the alignment of this? Discount rate is on the left, NPV is on the right. If we draw a chart, whatever is on the left will go to the x-axis. Whatever is on the right will go to the y-axis. I believe you know that from the charts. So I highlighted, went to insert. I'm inserting a chart, and you will see they already give us recommendations. So you can choose the recommendations, or you can also go and draw yours. But I feel that the recommendations they give will always give us the good thing. And you need to read the description. Read what is described down here. A scatter is used to compare at least two sets of values or pairs of data. Use it to show a relationship between two sets. We are looking at a relationship between discount rate and then PV. So this one can still represent our figure. When we come to the second recommendation, it's telling us this is a clustered column, and it is used to compare values. Are we comparing values across few categories? No, we are not comparing values, because these are in percentage, these are figures. These are not all values. Use it when the order of the category is not important. In our case, we need a discount rate, not values. We only have one value column. So I will even choose on the first one, or go to this other one, line, because we are told line shows a trend over time, and we can use it where there are many data points and the order is not important. The order is important. The order is important. But even this first scatter will really show what we are looking at. I've clicked on the first recommendation, and after clicking on the first recommendation, I move it down a bit. Let me just pull it here, and I can increase the size so that it is clearly visible. And you can see that x-axis are the discount rates, y-axis is the what? Is the NPV. Then if I click on it, I can choose the chart design and choose any of the chart designs. I can go and choose even this one here. We can choose any of the chart designs, because I want us to see the point at which the line crosses the x-axis. We can even choose this one here. Yes, like that. We can even choose that. Then we make sure whenever you insert a chart, make sure you label the axis. Make sure you label the axis. So the y-axis represents the NPV. Then the x-axis represents what? Represents the discount rate. I can just even type rate. Now, when NPV is 0, look at the y-axis. When NPV comes to 0, it is when the line crosses this x-axis. So at this point, when the line crosses the x-axis, that is where we have our IRR. And we already know our IRR was 16.75 using the Excel function. So we can also see that it is falling somewhere around there. Using a graph is an estimation. So at this point, you can see Excel is showing me that that point is 0.17%. Yes, you can see it is 17. That is still an estimate. Graphs are for estimation. So because you already know the exact thing, why don't we insert a text box, and then after we insert the text box, we now name that is the point, because the examiner wants to see from your chart. The examiner wants to see what is the IRR. So tell the examiner there that my IRR as shown in the graph is there. And because you already know the figure, just mention the correct figure, 16.75%. Because the chart will only show an estimate. But the examiner also knows that there is an Excel function, and they expect you to use it so that you know what you are showing in that your chart, like that. Once you insert that chart box, text box, then you will show where your IRR falls. And make sure you also give the title of your graph. And the title of your graph, you can say NPV against discount rate. Against discount rate, like that. It is still okay. Because NPV is the Y, so it is Y against X, NPV against discount rate. The title, you can give anything. You can just say a graph showing NPV and discount rate, or the relationship between NPV and discount rate. Whatever description, so long as you are describing the same thing, you are good to go. So members, somebody's saying what? Members, I see it's almost 10 minutes past 7. I would not wish to continue past this because I know members are going to work. What could be wrong? My NPV is populating the same NPV in the table. It is because you did not interconnect your cells well. You did not interconnect your cells well. You see those people who are having the same NPV. This NPV that is up here is what is showing here. Is because you forgot to write the discount rate, what I did. You see what I did here? Just click on your NPV formula. Make sure the rate here, you are referring to that cell where there is 12%. Do not type your 12% here. Do not type your 12% here. Make sure the 12% given here, the 12% used, is you refer to that cell where it is. Make sure you refer. Once you do that, your figures will be okay. Make sure your NPV computation, the rate that you've used, is referring to that cell where the discount rate is written. You'll be good. Please just do that and you'll see it working. Just do that, then you will see it working. So members, I would wish to stop there and have a good day. Thank you for showing up and participating in this class. See you tomorrow. God willing.